Yeah, hi everyone. This is Souvik Tripathy, and I'm founder and CEO of WebRoland, IT and digital marketing firm based out of Kolkata, India. So, yeah, today we'll be discussing about the trading part of crypto. So, perhaps you all have the idea about how the market behaves, especially in the bull market or in the bear market. So, today, what are the topics that we'll be discussing is like fundamental analysis and technical analysis. We'll do the comparison of those two analysis. Next, we'll be discussing some of the technical indicators, and then we'll be discussing what are the things you should keep in mind while doing trading. So let's discuss about what is fundamental analysis and what is technical analysis. So fundamental analysis is basically nothing but to find out the intrinsic value of any particular asset class. That could be crypto, could be equity, could be bond, or any other asset class. Okay. And the technical analysis is basically nothing but the derive, or you can say the projection of the data that is derived from the historical data. So it's directly related to the particular stock or into any account. Okay. So basically, what you have to do, you have to decide whether you can, invest for a longer term or whether you are looking for an investment that is for a shorter term. Let's say, suppose if you are looking for an investment which is basically, let's say, for 7 days or 10 days or maybe a couple of weeks, then you should do technical analysis. And if your view is like for a longer time period, let's say for a month or even 6 months to 1 year, even further, then you have to do fundamental analysis. So these are the two things that you have to keep in mind before jumping into any conclusion or before taking any position into the crypto market. Since crypto market is very volatile, so you always need to take care of your, analysis, and you have to do analysis in such a fashion that your decision, the probability of going decision wrong should be very less. Now, this is what technical analysis and fundamental analysis is as some of the use cases. So if you are interested in short-term or intraday trading, technical analysis works, and it's very much important rather than the fundamental analysis. If you want to invest for a longer term, then as I mentioned, the fundamental analysis works. So you can see the effectiveness over here in this graph itself. In the shorter term, you see the ineffectiveness of the fundamental analysis is very less. And as the time moves on, you see the fundamental analysis wins basically. And the technical analysis doesn't work that much. In comparison to the fundamental analysis, the technical analysis doesn't work that much. And also you have to, for a beginner, I would always recommend you to go with the fundamental analysis more instead of the technical analysis, because in fundamental analysis the chance of winning is much more higher than the technical analysis. But if you are a pro trader, or maybe if you are just, learning the technical analysis for a couple of months to, let's say, suppose a year or 2 years, then definitely you should do, both fundamental analysis and technical analysis, and I mean, take your decision. So fundamental analysis is more like a long walk, and for the beginners, it's a good idea to invest and hodl. Perhaps you are thinking about why it's hodl, not hold. Basically, hodl means hold on for dear life. So as long as you want, you can hold it, and eventually you will win. You will have the gain. Now, before going into the technical indicators further, I'd like to discuss about candlestick patterns. So these are the two types of candles that we basically see in any market. So let's discuss about the crypto market over here. One is bullish candle and another is bearish candle. Bullish candle is basically the left one side. As you can see, the green candle. This one is the bullish candle, and the price that you see over here, like this price is called open price. This is the closing price. This is the high, and this is the low price. And this deep green area is called the body, and these small lines are called shadow or wicks. So these terms you will find in many places. Wherever you start reading the technical analysis, so you have to be familiar with these things first. Okay, open price, close price, high price, low price, wick or shadow, and body. This is the bearish candle, the red one. So the open price should be here, close price should be here. So this is the basically difference between bullish candle and bearish candle. So open price of bearish candle is the close price of the bullish candle. So upper one is the open price and this one is the close price. This is the low and this is the high. Now let's discuss about some of the technical indicators. Key indicators basically I'll be discussing today. That is, one is DMA, that is daily moving average, or you can rather call it SMA, simple moving average. The next one is RSI, that is relative strength index. Then comes stochastic RSI, and then Bollinger Band, and final one is the MACD. Now let's discuss about technical indicators one by one. So moving averages, basically there are three types of moving average that you find. One is SMA, another is WMA, and the last one is EMA. EMA is just nothing but the exponential moving average. WMA is weighted moving average. SMA is simple moving average or daily moving average, you can call it. So I'll be showing you how to place these moving averages while doing the analysis in any technical chart later on in the XREX panel. So for the time being, let's discuss about the formulas. So this is the basic formula of SMA or DMA, where Pn equals to price of time period, and you have to divide the number of time period for which you are basically trying to figure out the SMA or DMA. The formula of WMA is this. So with this WMA or weighted moving average, there are a couple of indicators are developed. One, the mostly known indicator is like VWAP, and this one is the exponential moving average. So basically, when to choose DMA or SMA and EMA, that should be the question that perhaps is coming into your mind. So basically, for the conservative trader, you always go with the DMA, and for the long-term trader also, you follow the DMA thing. And for the short-term trader, or if you are an aggressive trader, then you have to follow the exponential moving average. The difference between DMA and EMA is, in EMA, the weightage is more given to the recent price changes. Okay, so that is what the basic difference. So you get the signals of buying and selling, in a more aggressive manner if you use EMA or exponential moving average. Lot of softwares are also being developed using EMA. Now there are two scenarios that you will find in while using DMA. Okay, these two scenarios are called death cross and golden cross, and remember these two scenarios quite well, because this is the phenomena that you have to check each and every time before you take any position for a longer time period. And here I am talking about longer means at least for a year or even more. Now, what is death cross? Death cross is nothing but 200 DMA line. Okay, whenever 200 DMA line and 50 DMA line crosses each other, and that 250 DMA line crossing the 200 DMA line from top to bottom, that meeting point or that junction is called death cross. And the reverse phenomena is called golden cross. So whenever death cross happens, you should not go long, or you should not buy anything. Okay, because eventually the probability is more to the market to fall after the death cross happens. And when the golden cross happens, you should always go long, and you can take your position for a longer time period. Basically, you can start initiating your positions in small quantities if golden cross happens in any, crypto coin or any other asset class. So here you should not buy, here you can buy. Now, the next indicator is relative strength index, that is RSI. RSI here, RSI means relative strength index, and you have to check two parameters basically, that is overbought and oversold. If the value of RSI is more than 70, then it's called overbought zone. And in overbought zone, you should not, adding up or piling up your position more, because it's already, in the overbought zone, and the tendency is to, the tendency of the market is to fall after that. The reverse phenomena happens when the market is oversold. So you can start accumulating your position when it's oversold, but you should not short, or you should not I mean, should not go short, or rather buy puts when it's already oversold or the RSI zone is below 30. So here you avoid buying, as you can see from this point, and here you avoid selling. Let me show you one example over here so that it would be much more easier for you to understand. This is the XREX panel, uh, and here now I'll show you how to put the indicators over here. Okay, so please check it carefully. This is the indicators thing, and put like moving average. This one. So this one is the moving average that we talked about, DMA or SMA. That is simple moving average, and this one is the exponential. Okay, so you can set both. Let's try with the moving average first. Now, in the previous slide, I mentioned about 200-day moving average and 50-day moving average. So now, if you want to place two moving averages, then you have to click it twice. Okay, now as you can see, MA, that is moving average. 9 is basically the sample or day. By default, it's set 9, and you can change it from here. Let's say about 50. So this is basically 50-day moving average that I am setting in the chart, and I am placing like the color green and increasing the weight a little bit so that it can be visible properly. So this is what I set for 50-day moving average, and here you can set it 200. And let me make the style like red. See, this is golden crossover. This is death crossover. Okay, so this is how you can, I mean, set the indicators and analyze the graph. And the next thing that we'll be discussing about the RSI. Let me show you the RSI also. That is relative strength index over here. So you can see it's not visible properly. So in the same fashion, you can change it from here. And yeah, the upper band is 70 and 30, as I mentioned in the slide. So you can change the color scheme from this panel. Okay. Just to make it visible more clearly. Okay. So whenever RSI is more than 70, you should not buy. And whenever it's, I mean, below 30, so you should not sell. So you can start buying when RSI is below 30. So this is the best time. You will get the things in cheaper. Okay. Now let's move on to the next indicator, that is stochastic RSI. In stochastic RSI, you basically will get two things. In RSI, you will get the buying and selling opportunity. But if you take a close look, see from here, if you start buying from this point and start selling from this point, so from this point to this point, it's 1st May 2020. Let me set it like daily chart first. So as you can see, it's the 23rd Jan 2022, and this is the 70 zone where it crossed 70 zone. So this is basically 28 March, from January to March. So isn't it like that? So what should I do if it's in between? I mean the 30 zone and 70 zone, and most of the time you would find that it's in between 70 zone and 30 zone. So that is the time when you have to consider the stochastic RSI. In stochastic RSI, like this, you will get multiple buy or sell signal in between these two zones. Okay, so let me draw the stochastic RSI over here and show you when to buy and when to sell. As you can see, this green line and red line. So whenever this green line crosses the red line from bottom to top, that is the point you can initiate a buy signal or you can buy any crypto coin. In the reverse fashion, whenever it crosses the red signal, the green line from top to bottom, you can initiate the sell. Okay. In between also you will find this kind of phenomena. You see small crossover is happening over here, over here, over here. So based on these factors, you can take your decision whether to buy or sell in the crypto coin. The next indicator that we'll be discussing is like Bollinger Band. So Bollinger Band is nothing but an indicator that you will use when the market is range bound for a quite a longer time period, and now it's on the verge of giving breakout or breakdown. So this scenario can be explained in a very well fashioned manner using Bollinger Band. Let me show you how. In Bollinger Band, this one is called upper band, the upper line, and the lower line is called the lower band. And the middle one, the the yellow one that I set it, that is called the mean value. Okay, so the tendency of the price is always go near to the mean value. The moment it stretches or the moment this is squeezed up, let me show you one example. Like here, okay, the you have to always check the width of the band, the distance between upper band and lower band. And when you start seeing that, okay, now the distance between upper band and lower band is very less, and it's keep on, I mean, staying like that for a quite longer time period like this, the distance between upper band and lower band is getting smaller, smaller, and now this kind of phenomena would happen or may happen. That is crossing this mean value from bottom to top with a large green candle and also with some additional volume than the previous day volumes. So that time you can be sure about, okay, now this is the right time to make an entry at that particular point. See, for the confirmation, you can wait for 2, 3 more candles, and you will find that after this thing happened, the rally started from here and went up till 67K for the BTC. In the reverse manner, whenever things are, I mean, see the width between upper band and lower band is very less, and it stays like that. And after a couple of days, what happened? You see this red candle crossed the mean value from top to bottom with some volume, additional volume. If you just make it a little bit zoom, you will see that the volume is pretty much larger than the previous couple of days volume. Then you have to wait for 2, 3 more candles, and you will see that the price will eventually go down further like this. So it started crawling from 60K till 32K. In between, you can see this kind of phenomena. So this is the false signals. That's why you have to check the candlestick pattern that it is forming as well as the volume alongside. You have to combine, I mean, both these things. You cannot take decision based out of one factor. You see the green candle, but the volume is very less. That means it's the fake signal that it's giving. And that is basically formed by the, I mean, you can say FII or maybe institutions or hedge funds or HNIs. Okay. Just to hit the stop loss of the retail investors. But if you, I mean, get the proper signal, like it's the fake, I mean, candle that is forming over here, so you shouldn't go long at this point. You should wait for a couple of more candles and you will get to see the actual picture over here. You see? and 2 3 more candles, it's not going up this mean value. So again it will go down further. Okay, so this is how you analyze Bollinger Band. So there are three scenarios that you can that you can utilize the Bollinger Band. For short-term trading, you can set the 10-day moving average and bands with like 1.5 standard deviation. That those values you can set from here. Going into the settings and inputs from here, you can change the length. You can change the multiplier. For medium-term trading, you can set it like 20 or 2, and for long-term trading, you can set like 50 and 2.5. Now, the next indicator is MACD, that is moving average convergence divergence indicator. So using this indicator, so first of all, let's understand when to use this indicator, because there are a lot of indicators and you might get confused which indicator to use when. So this is the ultimate thing that you need to know, which indicator I should use when and up till when. Okay. So MACD signal is basically used for short-term trading period, not for longer-term trading period, because in MACD, the maximum number of daily average that you will find is like 26 period of EMA. Okay, so not more than that. So you can predict that, okay, I'm getting only the maximum number of days. Sorry, the exponential moving average I'm getting is like 26. So the trading span should be medium term or maybe short term, not the long term. Now, what are the things that is here in this graph? This is called, this blue line is called MACD line. That is basically nothing but 12 period EMA, that is exponential moving average, minus 26 period EMA. The red line is called 9 period EMA, that is MACD signal line. And these things are called histogram. So in different panel or different platform, you sometimes you would find the MACD signal like this on the graph itself, and in some of the trading terminal you will find on the bottom of the graph. Okay, so this is basically same, nothing, major difference is there. Now, when the MACD signal would give you the buy signal, when this blue line crosses this red line from bottom to top, that is the point where you start observing the later on candles. You should not take position. If you are an aggressive trader, then you definitely can. But if you are a conservative trader, then you have to wait for a couple of more candles. Okay. So this is when, this is called the baseline, this line. So when this MACD line crosses the MACD signal line from bottom to top and also crosses this baseline, that is when you get the confirmation, okay, now I can go bullish. Okay. And also the reverse phenomena is from this point when this MACD line crossing the MACD signal line from top to bottom, at this point you can start selling, and at that point where it's crossing the baseline from top to bottom, you should be exit from your all your positions. You should not hold anything at that point. So you start selling here, start selling like say few quantities and make it 100% when it crosses the baseline, because see after that what phenomena can happen. Okay, now there are a couple of things that I would like to say, like whenever you take any decision while trading, you set 3 or 4 indicators together and try to find out the probability, the maximum number of probability that you are getting from those indicators. So if the probability from the, let's suppose I am setting 5 indicators, and out of the 5 indicators, 3 or maybe 4 indicators are giving me the buy signal or sell signal. I always should go with that probability. Okay. So it's not like you use only one indicator and it's giving me, buy signal and let's jump into the trading platform and buy that. No, you always need to go with the probability factor. And what are the things that you need to keep in mind while doing trading? Set a time frame on charts that you want to study. that is daily time frame or hourly time frame or 15 days time, 15 minutes time frame or maybe 5 minutes time frame. If you are an intraday trader, then let me show you. From here you can set that thing, set those things. If you are an intraday trader, then you set your time frame like 5 minutes time frame. If you are a swing trader, then you can set 30 minutes or maybe 15 minutes or maybe 1 hour, but not more than that. If you are a long term trader, or rather I would say investor, then you definitely should place it like 1 day or 1 week. So you have to check the weekly candles and daily candles at that time. In weekly, let me show you how weekly candle looks like. So this is how weekly candles look like. Okay. And you will get, the reason behind is like you will get more number of samples if you minimize the time frame. So it would be easier for you to take the decision if you are an intraday trader, if you set the time frame like 5 minutes of chart from here. Okay. Set the indicators to understand the texture of the market, that is bullish, bearish, range bound, that I already discussed. Look at the support and resistance level before entering into any trade. See, you, I mean, should not enter into any trade when the things are on the peak. Okay, because the probability more is to fall from the peak or to retrace the rally that has happened earlier days. You can see the market never goes up or down in a straight line. It always forms waves. So you have to find out the peak of the wave and the bottom of the wave. Nobody knows the exact peak of the wave or exact bottom of the wave, but you always try to, I mean, increase the probability to reach near to the peak or near to the bottom. The more you practice, the more you would be, I mean, good at it. And you should always buy at this zone and sell at this zone. So it may happen that you take, I mean, BTC and go long around 38K current price. Okay, and now you thought about, okay, the BTC goes from here to, let's say, 45K, and you sell your position, and after very next day you, I mean, you just notice that it's 50K. So you think about, okay, now I lost 5K run. So what would I have? So don't regret those decisions, because you never know. It could have gone like till 30K also. So you would be sitting up in a huge pile of loss under that scenario. So don't regret. Just take out your profit and cut your losses. Understand different type of orders, that is limit order, market order, that you can see in this panel, XREX panel. From here you can place limit order. So limit order is basically nothing but at which price point you are trying to buy or sell any particular product or particular crypto. Market order is like you have to just set your amount for which amount you would like to, I mean, buy any crypto, and the trading terminal itself would take the latest best, I mean, price value in the open from the open market. Trade in USDT pair and in the coins where liquidity is high, because you should not end up like buying cheap coins, I would say. Okay. And also try to, I mean, do trading in USDT pair because the liquidity is very high. So you will get plenty of opportunity to make an entry or exit. Otherwise, you would be stuck. You suppose you place, I mean, you have taken any crypto coin and you try to, I mean, exit from that crypto coin, fearing of that it may go down further. So if the liquidity is not high in that particular crypto coin, then you'd be losing up your entire capital that you invested in that crypto coin. So use the liquidity and coins where the liquidity is very much high. Know your risk appetite and trade accordingly. See, someone's risk appetite could be, I mean, say, I want 20% gain and I would exit from the market. And someone may think that, okay, 20% is not sufficient enough for me. So my profit should be 50%. So based on your own risk appetite, you should fix your target and your stop loss. And also always try to, I mean, set one stop loss in your mind if you place any trade. If you are an investor, then there is no point of setting any stop loss, because eventually at the end of 3 years or 5 years down the line, you'll be making profit. But if you're a trader, then definitely you have to put a stop loss. And if it hits, then definitely you would be exit from the market. And keep booking profit, because unrealized profit is unreal if it's not reflected in your account. So you can see that if you suppose you have taken any position around 40K BTC and it went up to 68K, the people who forgot to book their position around 68K previously, then they are basically regretting at this point, because it went down like 32K. So you can think about this scenario. So profit that you are seeing in your terminal, that is unrealized, it's not real. You should book your profits and take the money to home. Otherwise, and nothing can happen. So there are few of the resources through which you can learn more about crypto and trading and all those stuff. The best YouTube channel that have found so far is like Coin Bureau. You can go to this link, and some of the websites that you have to follow regularly. That is Coin Market Cap, Coin Telegraph, Coin Gecko, Coin Crunch, and XREX advanced trade terminal that you can use for the trading purpose.